how much does like the market really care? Like, I feel like like jolts and stuff or jobs or first week of August. I guess that's coming up soon. Like, is it possible to get back to that regime where like good news is bad news? You know what I mean? Where remember when like I think it was like 22, you get like these hot job prints, and, like the market would like sell off, and like people who weren't didn't follow stocks too quickly are like, what the hell's going on? I thought jobs were good, right? And like I don't think we get back to that or anything, right? But like I don't know. I'm a novice.
Well,
That's why I
well,
pay you guys.
yeah. So this is what happened in 22, right? If we go back, let's see if we can go back further on the terminal rates here. So it happened in 22 all through it. You basically had these job prints that were instigating the Fed to hike rates. Like the Fed started 22 at zero. Basically, the terminal was at zero for the cycle, and it just went up and up and up and up and up and up and up, at all points, at every juncture where jobs were coming in hot, market was like, oh god, that means the Fed's going to go higher, higher. I didn't really know where the ceiling was. Like, maybe a good way to show this is with the benchmark. Whoops, sorry, both benchmark and yeah. So you could see here, right? So terminal starts lifting up in 2021 in expectations of hikes. This is like the lead. The upper is the leading in hikes. The min is like the estimate terminal and terminal low. Basically high and low in the market. So the high starts ripping, indicating very early on the Fed's going to have to lift rates, right? And the Fed doesn't lift rates until 2022. Market's already way up here. Market's already almost at 2.5%. Min is the minimum basically over the next 3 years is lifting with this, insinuating that the market is essentially pricing in a higher and higher policy floor. So we really should be looking at both these lines. As this line is ripping and jobs are coming in, the market's first thinking when it first ripped back in 21, right? It's thinking 2%. The Fed maybe gets to it, settle down. Things started relaxing into 2022, and this was right when the market started falling apart, like right into 2022. The upper bound terminal rate starts ripping towards 3%. Lower bounds lifts up to, basically 0.3%. The Fed's at 0.3%, the low's at 0.5, and the upper's at 3.2. And what that tells you is when the upper and lower are above the Fed funds rate, the market expects zero probability that the funds rate is going to be lower than where the Fed is at any point in the next 3 years. So this was the kickoff of the regime where everyone was like, oh God, the Fed is just going to go on a hiking cycle. And this started in early 22. And as the upper end bound of the terminal rate ripped, everyone was thinking, okay, like this has to be this, 3% is the top. Jobs keep chugging along. Okay, then 4 is going to be the top, and then you have like, okay, maybe 4.5 is the top. And this constant re-rank higher of policy is what basically shocked the market on all that good news is bad news data. And what ended up happening now is once the rate peaked and rolled over, so now you can see the upper bound is at 4.37, the Fed is at 4.33, and the lower is at 3.15, essentially saying that very, very high odds the Fed funds rate is going lower. So the good news here is essentially good news in the fact that the Fed is not going to have to lift rates up. Like, you're not seeing upper end rate expectations go higher on any of these good economic prints, likely because the Fed is deemed to be somewhat neutral, not necessarily overly restrictive, right? The Fed is not in a position right now where it's like, ooh, we're going to crush the economy, and you could thank the deficit for that. But all in all, the market's in this brace period where like good news means that the Fed is essentially not late. And the good news that we're seeing get priced into the market isn't essentially taking away from rate cuts. Like, you can see here on the terminal rate for the min value, right? Like, all this good news that we've been having, the terminal is still lower than where it was in January. So terminals are still low on a relative basis over the last 2 years. They're not at the upper end of the range. So you can basically see that the good news is good news because the Fed gets to cut rates into a moderating warm economy. That's what the market's liking here with the deficit, etc. The only issue I think the only thing that poses is an issue is the inflation swaps are, while terminals are at near 2-year lows, inflation swaps are at near 2-year highs. And we need to see this really break lower. If this breaks lower with the good news that we're seeing, jobs continue. Um, all in all, you've also seen a weakening in the labor market too. It's not like the labor market is piping hot. Like the labor market has been slowing in terms of NFP job creation and job growth. So that's all positive. That's all that's all telling you that look, the labor market is slowing down. It's not piping hot anymore. The Fed is indicating that they're going to cut rates. What are they cutting rates here? By December, 1 to 2 times at least, and the implied rate by the end of the year is going to be under 4%. It's generally a good thing when the deficit is so high, inflation is somewhat contained, the policy path is slowing slowly here, and jobs aren't imploding. You kind of have this Goldilocks situation. That's why I think good news is good news, at least at the moment.
Yeah, I think
Yeah.
for us to lose this and get back to where good news is bad news is if the economy is running very hot as it is now, and then we start seeing inflation expectations ticking up.
I think you need like a three handle
Yeah.
on CPI and stuff again. And then I think the market looks at that and starts to get upset. But as long as it's a 2 and jobs are strong, like I just have to keep chugging up to the right. You have to imagine.
Yeah.
Yeah, I mean, keep it simple like this. As long as the U.S. inflation swaps, as you can see in the global swap monitor on the quant base, as long as these are below like 2.7, right, 2.65, 2.7 in that range, as long as they're below that, I don't think the market really cares. Like we saw this big surge up post Liberation Day in inflation expectations, right? But we have not been able to take out the highs. Now on like something like 5-year, they look a little bit more aggressive, but that's again, they look even more aggressive on 2 years. That's just because of the transitory tariff impacts. Like if you look far enough out, you'll see that inflation isn't really detaching just yet. And I think that, even on 5s, like it's up there, but we're still not really, holding over the 2.7 level, 2.65. Like you were saying, 3% on CPI. I think 3% on inflation swaps is a bit too aggressive. Like to think 2.75 above there is probably problematic. As long as the swaps are below there, I don't think we really have much to worry about in terms of inflation expectations. I think that the transitory effects from CPI tariffs are going to be flowing through, but all in all, everyone's looking past that to some degree. Swaps are up, but they're not breaking out. These are all important things to understand. That inflation impulses are building and likely accelerate, but that doesn't mean you're going to have like inflation and building back up and basically multiplying in the system. And I think that as long as that doesn't happen, where inflation is multiplying and really, festering itself, you kind of can chuck this up to just price to inflation variance. Like, yeah, it's going to pivot between upper and lower bounds. And a good way to think about this is if inflation's at 2.5, if swaps are at 2.5, 2.6 right now, and the Fed's at 2 cuts for the year, what happens if swaps get back down to like the 2.25 or 2.35, 2.4 level? Then we're probably looking at even more cuts. So the market's kind of looking at this as a lopsided trade where risk to reward is inflation's not breaking out yet. So the odds of the Fed going anywhere is obviously lower, not higher. And on top of that, that means credit conditions are going to continue to ease, but you have this fiscal stimulus and it's a net positive. The economy is running above potential, so it basically a rip-roaring economy, the stimulus maxing economy. And the downside of this is if this keeps going and the Fed does cut too much, which as you can see, the terminal is still higher than where it was in 24. Like last summer, terminal is still way higher. If the terminal really starts diving and we start getting into like 23 levels and 22 levels, with the current deficit, I think that's when you're going to start to see these swaps like start ripping, and that's going to be a situation where like the Fed would have to would be running the risk of having to reverse policy, and that's probably going to be where the good news is bad news. So until that happens, I think we're just in this Goldilocks environment.
Yeah, it's really like a win-win kind of situation. Like as long as inflation remains predictable and above that 2%, it doesn't really matter. Like that's helping the risk on regime. Inflation is good for
And I think,
assets.
yeah, if they start talking, like if it stays in that over 2.5, like not too hot, but like close, higher than their target, if they start talking like, well, it's not that big of a deal. Like they're not like, no, we got to get to 2. We got to, like the Fed like speak. Like whenever there's that talk of like, well, maybe 3 isn't so bad. Like Bitcoin's going to like 200. Like when they start normalizing that talk, it's not so bad to have a bit of inflation, and that's when like that kind of thing just takes off. That's just my opinion. Anyways, I've sidetracked you guys enough. I really appreciate it. That was great.
No, this is good. I think we may as well just include this in the podcast. I think it's a good question that a lot of people are thinking.
All right, so let's take it on to the next step here. NASDAQ is flirting again with closing at, or it did close at all-time highs and looking like it's going to be making all-time highs again tomorrow, at least right now in the post market here. What do you think about this, Artie? What's the word?
I mean, it's very bullish, that's for sure. We haven't had a pullback to mid vamp in quite a while. Me personally, I'm gonna sell some calls. Like I already did last time we got to upper vamp. I was able to make a little bit of money on that. I didn't let them expire. I just I took them for like a 50% gain. And then if we get up to upper vamp again, I think I'll do the same because I am getting a little worried. Like there's got to be a dip at some point. And I think a lot of people are thinking that right now. And the market is just not giving it, which I'm not complaining, but I'll try to make some money on both sides without cutting my profits. I gotta kind of be careful with where I'm selling calls. Really just do it when
Absolutely.
it's getting overextended into upper vamp.
Yeah, I mean, this is one of those markets where like pretty much, I mean, let's go back to April, right? Every dip at mid vamp has held, even the one in June, you count this as a slight one, right? Whatever. But like every dip to mid vamp is held at every juncture. So as long as you're above it, we keep saying this, it sounds very repetitive and it's probably even annoying to some degree, but the base case is new highs. As long as we're above the mid vamp level right here, right, which is currently, as of recording this, it's 559. As long as we're above 559 on the Qs, look, just expect new all-time highs. Just like that should be where price drifts.
Yeah,
Now,
like we've got the regime in our sales. Everything is really lined up. There is not much of a bear case right now.
No, but I do think that the first snap's probably going to scare some people when it does happen, right? Because it's like one of those things where every dip is bought up until the dip that dips and it's not bought up. And I'm not saying that it's going to be a severe dip, but essentially what happens is, once you lose that mid vamp level, lower vamp, green line 549 becomes base case, at least for chop, right? So when you're above mid vamp, the base case is new highs. When you're below mid vamp in a bull trend and regime in your favor, the odds are that you just have bullish trend consolidation, and then you can, once you get back above, you go back into your new all-time high routine. So I think like the dip that happens if we do get one, like I'm not calling for one. Base case right now is all-time highs because we're above mid vamp. But if we do, you have to expect that you have to be comfortable with a move to like 549 at least, right? Like you just got to understand that if you lose mid vamp, lower vamp's the next target, and if you're positioned in a way that you get liquidated, then you shouldn't be positioned in a way like that because that would be the next step, and you don't want to get liquidated in simple market pullbacks.
Yeah. I think what would cause a pullback would be long end yields coming back. Like they kind of haven't been an issue for a bit now. But if TLT starts dropping again for whatever reason, I think that's going to be what causes the pullback.
Yeah, that's a good point. I mean, we have FOMC next week. We'll talk about that, and then we have NFP I think next week as well. Or yes, right? It's Friday, I think. So there's a double calendar next week in terms of volatility, and all in all, like just look at the situation here. Their 30-year yield is just under 5%. We are well off the Liberation Day lows, which was about 4.4%. So we're nearly 50 basis points higher. But we haven't taken out the 23 highs or even the May highs, which we ripped to, and that's when everyone was panicking about people dumping U.S. dollars. The U.S. economy is going to be worthless globally. No longer the place to put your money. That whole panic trade got unwound, and then rates kind of fell, and they bounced back up high, lower high so far. I think as long as the 30-year is below 5%, things probably are okay. Now, what matters here again is what's going to fuel the rates. If the 30-year breaks up to like what you're saying, but it's due to basically, it's essentially due to the idea that of debasement and runaway deficits, and the Fed not reacting, or the Fed having a broken reaction function, then I think what that really means is, it's a different trade altogether. You're looking at basically a debasement play where NASDAQ should do well, Bitcoin should do well, even if rates are ripping, right? A lot of people like to say, oh, high rates are bad for stocks, because theoretically, rates ripping rates ripping that instigate a tighter Fed, right? If rates are ripping because they think the Fed is going to massively tighten, as they did in 22, 23, that's very bad for stocks, because the cost of capital is going to go up, right? To borrow. But if rates are ripping because there's a fear that the Fed is not going to do enough, and the cost of capital is going to remain, significantly below the inflation rate, then what you're going to basically end up in a situation where is everything's a debasement play, right? So rates going up are one thing. I think if it's being fueled by a debasement run, basically a widening in term premium, you can think of something like, some sort of panic selling, anything like that, around the fact that they're just not, lower credit ratings, things like that, where assets become more cash-like than cash itself as a store of value. At that point, I think it's a bullish everything play, not so much, stocks versus bonds.
Yeah. Well, what brought us to above 5% last time was the fear that we're going to be entering into a recession while we already are running a massive deficit. And that's just going to cause us to run an even larger deficit, and bonds get completely destroyed. So do you think like any inclination of a recession or any slowdown or anything is just going to push yields higher like that?
It's still to be debated to see if we can have a recession with a 6% deficit, right? At least in the United States, 6 to 7% deficit. We've yet to prove that. Like,
Yeah, but like if the market starts like that, like some slowdown data starts
Right,
coming
okay.
out, like do you think we're just going to shoot back up to above 5%?
Well, it depends, because see, what fueled the last run in yields earlier this year was this idea that we were going to a recession with a high deficit, right? But also on top of that was the inclination that, due to tariff policy, right? The administration putting global tariffs in play. A lot of countries, they didn't have the reaction function. A lot of these countries don't have real reaction function given to tariffs, given that they're net exporters, right? They don't necessarily need to buy or I should say, they don't necessarily need to import things from America, because America's the global commerce spot where everyone's selling everything into, right? That's how it works. America's the vacuum for goods. So in a situation like that, their way of retaliation to prevent them from not being able to sell goods would be into America, would be just to like start putting pressure on the long end. All you have to do is essentially have Japan, China, India go into a closed door meeting and say, all right, it's time to sell. All of us at once, blow them out. That's our response, And that's, I think, what the market was afraid of, because that you basically go from, trade policy to capital wars quickly, globally, when there's no other option on the negotiating table. And I think that's what the market is even still fearing today, is given the high tariff policies in America, and, the high level of, or the low level of predictability, there's this disincentive to hold U.S. assets, at least as a foreigner, right? because you don't really know what's going to happen next week. And I think as long as that's a thing, like there's going to be term premium on the long end just because of that. And the deficit alone is adding term premium on top of all this. So if you get a recession, I would think that the bond yields probably go up, because if the deficit's already 7%, the economy running below potential would only blow a deficit out even further to rejuvenate it. And that alone will just add, you're talking low rates. Sure, it will cut the deficit down, but we'll have to do even more stimulus. And, a 4% deficit is not going to get you out of a recession. It hasn't historically, So
Yeah.
if rates fall because of a recession, see, there's two sides to your equation there. If you get a recession, rates should fall. But if the deficit is strong, right, it's going to offset some of that with inflationary pressures, so they can't bring rates too low. But even though, nonetheless, it should lower the impact of the deficit, because a part of the deficit is interest expenses, which will fall. But that doesn't really matter, because they still have to stimulate the public sector. So they'll have to up the other parts of the deficit expenditures to basically bring in more stimulus into the economy, which will only then bring the deficit back to where it was essentially, and just keep the ball rolling in terms of high deficits, and then lock in a whole nother cycle, right, where rates will then rise again and they'll be even worse, right? You go into a recession with a high deficit and you add even more to it, interest rates fall, and it gives the illusion that, look, like, we can add more of the interest expenses have fallen. Well, what happens on the next round up when interest rates rise again? Then you're going to have the compounded effect. So that's why I think term premium right now is going to be a persistent thing until either spending is cut, taxes are raised, or there is real fiscal growth. There's real growth to offset fiscal spending. Unless one of those three things happen, I think that we are in a position where bonds will just hold this regard for, uncertainty and high term premium.
Yeah. Yeah, it really seems like gold is the only play for a recession at the moment.
At the moment, yeah, it does. I mean, historically, gold has been, whatever. It hasn't done the best in terms of plays in the past against slowdowns, recessions. Bonds have outperformed gold, but this last cycle really, gold's taken a lot of spotlight.
Yeah. Yeah, I think the change that we're making to RQF to buy gold if bonds are bearish trend, I think that's a very good update, and I think it's going to add a lot of protection.
Yeah, it's a strong hedge. It's just one of those systematic hedges you put in place that kind of bulletproof the model a bit more. Give it basically a fallback if something's wrong with a sector or underlier, and things aren't making sense, but things are kind of making sense, but one of the holdings isn't working, but the other one is. Having a good fallback is very important, especially in an environment like this where it's very easy to understand why bonds just are trading with a weighted vest, because it's fiscal weighted vest. I mean, deficit's 6-7%, interest rates are 4+% across the curve. It makes sense.
Yeah, and you can't default on gold.
This is true. And it's also one of those plays that can get a bit of a debate. Obviously, gold versus bonds are good in recessions, but when currency gets rapidly debased, gold will actually hedge, right? Bonds won't. Gold does okay in recessions, but gold is also an inflationary hedge in the terms of debasement. It's not a good risk-on inflation hedge. It's a good stagflation, right? Risk-off inflation hedge. And I think that having that optionality in the model is probably a good hedge for the future where environments like this are uncertain. I think eventually bonds are going to be good again. We'll trade them at some point, make good money in them. But in the meantime, or even after that, at some point, I think that this situation could likely repeat itself, if not here, somewhere else in the globe, right? So having a model that can absorb those differences is quite important.
Yeah. And this is really kind of a new issue. Historically, we didn't include gold into RQF because it actually made the performance worse. It was better to just go all into bonds. But now it's in the last 5 years or so, that's really when it started to price it in, was during risk off periods. In the last 5 years, gold actually did better. So I think
Right,
it's
right.
pretty likely that it's going to continue. Like this is not a new issue. It might seem new to a lot of people because it just became more apparent in the last year, but the market's been picking it up for the last 5 years.
Just gradually, right? And like I think to the point that you're making, this is market cyclical. Like bonds will be tradable again. There's this understanding that the Fed's going to reduce rates, market will chug along, but ultimately, there will be, there's going to, you don't run into periods of indefinite economic expansions. There are contractions, right? And in those environments, I think that maybe they'll be fiscally driven. Maybe, again, administrations change every 4 years or 8, depending, but this one's going to change in 4 years. Who comes in is going to be a key player in terms of deficit expenditures. Like maybe Trump's plan works here and we can get some growth. We could basically grow our way out of it partially, but to think that there's not going to be some sort of tax issue, tax offset or spending cuts in the future. If you don't do that, you're basically playing with banana republic status, right? After a certain point, this becomes just whatever, right? Like there's no no one's gonna take it seriously. Then debasement's the only way out of this, right? In reality, that it seems like that's the likely case regardless. Inflate the debt away somehow, some way, but um, there will be acknowledgments along the course that determine how aggressive they're going to be with that. My theory is, at some point, everyone's going to turn on the Fed.
Yeah.
My theory is that you're seeing it now with the Trump administration, and even both sides, both parties are like going at Powell at this point, and it's only going to get worse. Powell's not going to step down. He's definitely not resigning, but he's going to effectively step down from his position voluntarily when he has to at the end of his term, and a new chair is going to step in, and the new chair is going to be faced with the same problem Powell is faced with. There's only so much you can cut rates in an environment where the deficit's 7% and you're not in a recession without risking inflation. Like that factor doesn't matter. It doesn't matter who the chair is, unless they're just going to be blind monkeys just cutting into oblivion, right? Pray to God that inflation doesn't go to 10%. Just keep cutting and pray we can grow out of it.
Yeah. Well, they're going to have to convince the entire board to do that.
Yeah, it's true. And I think that ultimately the Fed's going to, in this environment where deficit spending is rising, and we're not necessarily creating the interest rate environment that would help alleviate the deficit expenditures, only make it worse. Everyone's going to look at the Fed and basically say that the Fed is handcuffing the fiscal policy, which that's the whole purpose of the Fed, right? The Fed's supposed to be independent. The Fed is supposed to handcuff fiscal when it gets out of control. These are what good checks and balances look like. But when Congress can essentially revoke the Fed, right? Congress can do anything if they all vote on it. And if that's the case, at some point, if this gets out of hand, the Fed is going to get fire from both sides of the aisle. So like that's the risk, I think, and keeping the Fed's independence is extremely important. Even if they have these weird mandates, sometimes some of these mandates come up in discussion, like the Fed shouldn't be doing this, shouldn't be doing that. Yes, maybe they do. Maybe they have a little too much on their plate in terms of responsibility, but in terms of actually setting monetary policy and interest rates, that's very important that the Fed stay independent. Otherwise, Argentina is not too far around the corner.
Yeah. Yeah, well, it was pretty funny seeing Trump with Powell today after calling him an idiot for the last few weeks.
Yeah, I mean, look, Powell signed up for the job. I just don't know if look, you heard of old chairman stories from the Fed chairman stories of like prior presidents getting pretty confrontational with Fed members, but social media has kind of changed the landscape of how things, you can send out a post and everyone and their mother on their iPhone or smartphone can read this real time. It's not circulating in a newspaper. It's not sitting on a news wire. You don't have to wait to get into the office to see it. You can just see it from your couch. And I think that this massive popularity behind trying to, or this big push behind trying to just trick everyone into thinking that the reason home prices are expensive, mortgages are expensive, and car loans are expensive, and all this stuff is just because the Fed doesn't play ball is probably a terrible approach, given that a majority of America has a very low education in finance, right? In terms of like, or they're not very financially educated. They don't understand that the Fed has little or to minimal control over the 30-year yield, right? Mortgage rates, even on a 10-year rolling basis, the Fed can somewhat control the 10-year, but the grip and grasp of the Fed's power, the further on the curve, is a lot lower, right? Without QE in place. And the reason that rates are where they are is because the government's, Congress is trying to push off the fiscal irresponsibilities to the fact that the Fed's holding interest rates pretty high. And I think that regardless of how you look at it, it's pretty deceiving. And I think it puts the false idea into people's minds that the reason why you can't afford a house is because Jerome Powell doesn't want to lower interest rates. And I think that's just such a ass backwards way to look at it, because, you saw earlier last week when headlines started floating around about Trump ousting Powell for real, the 30-year started ripping, right? Because this idea that there's a loss of independence at the Fed means that there's instability, which means there's uncertainty behind monetary policy in America, therefore a risk of higher inflation expectations. So just because the Fed chair doesn't lower rates doesn't necessarily mean, it's all the Fed's fault, when in reality, like, objectively looking at the economy, it's hard to argue that the Fed should be half of where they are today.
Yeah.
Right? Like, if you look at the economy and say, like, unemployment is, sub 4, right? NFP still chugging along positive. Payroll growth, jobless claims are trending lower. And you look at GDP growth is positive still. You look at this and say, like, should the Fed, like, where is the signal for the Fed to cut by 50%, right? Cut the rates in half. And there really isn't. And I think that's the big dilemma, right? Because from an economical perspective, everyone at the Fed, not just Powell, is looking at the situation and saying, yeah, the economy's just fine. What do they need rate cuts for?
Well, what do you think
Meanwhile,
about 2 rate cuts being priced this year? Do you agree with that?
I think that you have to, like, the policy path essentially is somewhat accommodative, right? Like, we're getting more and more, like, the Fed's mark for neutral is somewhere around 3%. So the Fed theoretically is telling you, based on the dot plots, that they're above neutral, they are in restrictive territory. And I think that there is some merit to say, like, look, labor is not as strong as it was a year ago, right? GDP growth is not as strong as it was a year ago. There's all these, like, little hints that are saying, like, the economy is doing fine, but it's not as fine as it was 12 months ago. So the Fed is looking at it. The Fed should be, and it seems like they are looking at this and saying, okay, well, there's obviously some deterioration here. It's not significant, but if we ease policy now, we don't run the situation of being significantly late to the game. And I think it makes sense. 2 rate cuts, 3 rate cuts, just really, you want to move the curve down. Or the Fed wants to move rates down without breaking out or having inflation expectations break out. Like, if you look at inflation expectations, they're the same that they were back in 2023 right now, right? Inflation expectations are the same on the long end they were in 23, yet the Fed has also cut rates quite a bit. So inflation expectations haven't risen, but the Fed's cut rates by, almost 100 basis points. So that just goes to show you that, like, the neutral rate is rolling over, in my opinion. It's slowly falling, and the Fed has to adjust for this. Now, if the Fed cuts too quickly, you're going to see inflation expectations break up and out, and that's going to be problematic. That's going to be very problematic for mortgage rates. That's going to be very problematic for any sort of, like, floating rate loans. And that essentially would be an additional tightening effect on the economy.
Yeah. Yeah, it's pretty well put. I'm in the same boat with that. Like, no rate cut this next meeting. And I think even just 1 rate cut this year would probably be enough. Like, yeah, there is deterioration, but at the end of the day, inflation is still above target. And that's something that they need to bring down to 2%.
Yeah, I mean, look, at the end of the day, the Fed there's a big game here. Like, if you cut the deficit in half, the Fed would be, if Trump had the deficit cut in half, he wouldn't have to ask Powell to cut interest rates at all. Powell be racing to do it. but that's not what happened. So situationally here, rates are expected to fall about under 4% by December. And then by June of next year, they're going to be about 100 basis points lower. So essentially, you're looking at 4 rate cuts over the next 12 months. That's reasonable, right? Like, odds are where inflation is over the next, 12, 14 months, where in swaps are in particular. If swaps are like higher than where they are today, odds are we're going to start taking cuts off the table. But if swaps start falling, I think you can actually see more than 4 rate cuts get priced in. More than 100 basis points of cuts. Like, if 10-year swaps go back to like 2.3%, then you're going to run into the situation where, okay, rate cuts can accelerate. But I think the reason why we haven't been able to really lose the floor on swaps, and I'll show you what I mean in a second here. If we look at where swaps were in 2018, they were at 2.37% on the 10-year. They haven't really been able to breach 2.3%. So if you were to draw a line across, the 2018, 2019 highs is essentially now the floor in the swap market for inflation. And my guess here is it's deficit. The deficit is fueling this. The Fed is significantly tighter, but inflation swaps are not back down there, right? Even though the Fed is double where they were in 2018, why are swaps like 50 basis points or 20 basis points, higher than where they were in 2018?
Yeah, and you also
Inflation
have tariff effects, tariff uncertainty baked
Right.
into that as well. So as long as these deals actually come through, that would help bring these inflation swaps lower.
Right. And objectively look at this, as long as inflation swaps are above the 2018, 2019 level, the Fed is going to be in the position that, look, policy is significantly higher. Inflation swaps are almost back to where they were in 2018. But, you look at the terminal rate is nowhere. Like 2018, we were talking about a 1.3% terminal rate. We're, at 3. So the Fed has a terminal rate of 3 in the market right now, and swaps are still not back down here, which essentially the Fed's going to look at this over a long enough time frame and say, okay, we need to essentially keep pressure on our for guidance to keep these swaps contained. Because if the Fed starts just cutting like Banana Republic, these swaps are going to go vertical. And that's not going to be good, because swaps are going to go vertical, rates are going to go vertical, right? Because if inflation expectations go up, then the yields are going to go up too. So all in all, I think that this is the dilemma, right? Like, rates are higher than where they were in 2018. Trump wants rates down to the 2018 levels, but inflation expectations, while rates are so high and quote unquote destroying our booming economy, they're not really damaging inflation. The rates are almost like, it almost looks like it from an inflation swap perspective, rates could be higher and inflation may actually come down a little bit. There may actually be more progress on inflation. And some of this delay is obviously tariff-related transitory effects, but terminal rates are not at lows. Swaps are not at lows, which is interesting, right? And the economy is chugging along just fine. So the Fed's looking at it like what we have priced into the curve is a risk-free bet. Like from the Fed's perspective, they priced in 4 cuts over the next 12 months. Inflation expectations aren't really breaking out, and the market's doing okay. So the Fed feels like it's in a sweet spot. Now, if one of these things start changing, like labor starts, unemployment starts accelerating, the Fed's going to get weaker real quick. Or if inflation starts accelerating, the Fed's going to get, tighter in terms of forward guidance. But we're in perfect balance right now.
That's sweet. It's bullish.
I mean,
Straight up
that's
from
the base
here.
case, right? That's the base case, right? Bullish. Even for Bitcoin, same thing as the Nasdaq. As long as you're above mid-vamp, base case is higher. Bullish trend, base case above mid-vamp, higher.
I'm very bullish Bitcoin. Like, this was not the full move yet. This was just the start of the move, I think.
I mean, we could just get a little juicy here real quick. Like, look at this, right? So you did this entire up leg here in late 24. Then you went down a 25% pullback. And you came back up. Then you went down to you did another 10% pullback, and now you're back up at 118. If you really want to do the math here, since December, similar to the Nasdaq, since January, Bitcoin's only up what? Like, let's see. Bitcoin's up, I'm going to ballpark this up. Bitcoin's up like 14, 15%. And yeah, this is a $3 trillion asset. Yeah, it's obviously very impressive, but to sit here and be like, oh, Bitcoin's ran a lot. Like, yeah, it ran a lot since the lows, but like, let's go back to where it was in December. And you'll realize, okay, it's not up significantly. Yeah, it's up significantly from the 2023 lows, but like, again, we could play the reverse game, right? You go to 2021 highs, you're up 82%. That number is a lot smaller than where you were from the $15,000 lows. So I think that when you look at moves like this, don't get so hung up on the retracements off of lows. Like on the NASDAQ, right? We keep saying this. Like the NASDAQ is up what? NASDAQ right now is up 4% from February highs. For the year, it's up about 9 to 10% for the year. It just looks big because it just went vertical off of a low that it's up 40%. But it's really like if you bought in December or you bought in February, you're up 4 to 5%. And everyone's weathered the storm so far. So, again, we go back to the saying, economy is running above potential. You got a large deficit. You got a Fed that is going to progressively ease, not tighten. And you essentially have an entire fiscal approach here that is bolstering asset prices. You have deregulation. You have all these things that like are basically begging for higher asset prices. So is 4% gain? Is it time to make up for lost time? And I think that's probably the better approach, right? The better angle to take here. It's time to make up for lost time. Thank you guys so much for listening. If you want to see our models in real time, go to market-radar.com, sign up today and get access to all of our data on an interactive dashboard.